This is the Financial Sense News Hour. Now, here's the Financial Sense News team, Jim Paplava and John Leffler.
Well, it was another good week for the stock market. Stocks up with new records set for the Dow and the NASDAQ this week. Hi, everyone. I'm Jim Paplava, and welcome to this edition of the Financial Sense News Hour. Joining me in Hour 1 will be Richard Dickson from Lowry's Research. Richard is saying basically buying power and dropping supply has been behind this rally following the election of Donald Trump. However, the rally that he's seeing currently, especially this week, is occurring with falling volume, and Richard says that could be a harbinger of things ahead. He's also saying the underperformance of small cap stocks. Does this mean we could be in trouble? Well, maybe a correction is ahead, so you want to hear what Richard has to say about that. Also joining me is Frank Holmes in the latter half of the first hour. He just got back from the SALT conference, and Frank is bullish on gold. He thinks it's going to bottom here at the end of May and June, and he thinks what's going to drive it forward, the big catalyst, will be negative interest rates. And of course, Ryan Paplava will be here to talk about what moved the markets this week.
And I'm John Leffler. We're going to take a look at megatrends right now. Do you realize that it's estimated about 5,000 retail stores will be closed during this year alone? And some experts are saying 40% of all shopping malls will disappear. Is this the end of that type of retailing due to the technology? Or what we seem to see emerging is a merger of the two. So the physical stores all won't go away, but they'll be merged with a lot of high-tech and online availability. We'll talk about that and what that means for investments. And also tectonic shifts and fissures in the financial markets. One of the striking things that we've noted here on the show for almost 20 years is that whether you look at the Fed or Wall Street forecasts, how often these, quote, experts, end quote, get all their forecasts wrong. So why are they doing what they're doing? Well, we'll find out how the difference, the chasm between the forecasts and the actual outcomes, like the euphoria we saw in the market after the Trump election, actually come about. It's going to be a really wild show today. We'll enjoy it all on The Big Picture as part of the Financial Sense News Hour. But first, another exciting week out there. At least it's been exciting this whole year between politics and the markets. Ryan Paplava back for another week talking about Wall Street. Here we talk about the catalysts and worthy stories influencing our financial markets, both here and abroad. So let's see. Let's pick subject one here. What can you tell us about the recovery from last week's Comey dip in the market?
Yeah, sounds like something to have on the counter at a party.
Or a new form of fertilizer, one or the other. I'm not sure which one it would be.
How would you like a little Comey dip?
Yeah.
I think it was more sentiment. And these 5 companies, we're going to talk about this, I think, more. I'm calling them the Fabulous 5. That's Apple, Alphabet, Microsoft, Amazon, Facebook. You know, the performance in those stocks, their market cap, quite an influence on the market. And those really helped rally the market out of that dip. I think those combined rallied like 4% plus out of that dip last week. But essentially it was a buy the dip situation. We had 6 consecutive positive closes after that drop last week. And going back to these 5 companies, if you look at the NASDAQ 100, so that's the large cap technology stocks typically, those 5 account for 44% of the market value. And the gap right now between the S&P 500 and the S&P 500 equal weight index, the S&P 500 is a capital weighted index. So if we take that capital weighted portion out and just make everything equal, the spread is almost 8% as of this Friday, with the equal weight index well below the cap weighted, heavily sensitive index towards these really mega caps. Quite a decent spread, and that spread continues to widen. If you actually subtract those companies out and you just look at the equal weight index, we haven't been able to actually break out to new highs yet since March. And news has been mixed overall, but I think this week there were some key stories that influenced some specific areas, and maybe we can kind of go into those.
Well, let's see, we had some meetings this week, too, that would be discussable here on the program. G7 met, but I really want to look at what you think about the OPEC meeting on Thursday and the dip that we've seen in oil.
Yeah, the OPEC meeting on Thursday was definitely one of those major events this week that influenced specific areas, commodities, oil. Essentially, OPEC agreed to extend their cuts, which we've been talking about for the past 2 weeks. There were rumors they were going to extend it another 9 months. Well, okay, that's what they did. If you remember me talking about it, there was a rumor out there that there would be possibly a bigger cut, something we talked about last Friday. When that didn't materialize Thursday, we definitely saw that 5% drop in oil. From here on, oil's price will be definitely based on inventory levels and U.S. production, unless something really major comes out. But if you look at how oil's been trading, it's been in a trading zone for some time. This was the nearest catalyst that could have helped to maybe jury us out of this trading zone, and that definitely didn't happen. I was looking at some data this week. I'm mainly looking at the Baker Hughes rig count, and we're up to around 901 rigs in the U.S. that are online, land and oil, gas, 901. And about a year ago was the low in May, actually, of last year at around 404 rigs. And the high, I went back looking at all the way to data from 1987, I think, and the high was about 2,031 rigs in 2008. Oil was up near 150 plus. So we're definitely off the lows. We're almost more than double, but definitely still well off the major bubble highs that we had back in 2008. We're definitely well away from those lows and from the highs. So looking at where the trend has been, you look at the rig count, it's almost every single month. There's more rigs that are online month by month. The other issue I see here looking at just oil in general is I bet there's a lot of producers out there, given the events from this week, that are probably hedging their contracts for 2008 production, given that OPEC was this week and there's not likely going to be any major catalysts. This was very well televised that they were going to extend the cuts, maybe waiting to see if they did more. That didn't happen, so we definitely saw that big drop on Thursday. But oil did bounce back on Friday, likely going to stay range-bound for some time until another catalyst takes shape. Trump also mentioned we should sell some of the country's reserve this week when he talked about the budget, but investors largely dismissed that talk. Essentially, we're focusing on OPEC.
Yeah, and speaking about rage-bound, it seems to be the slugfest in Washington that's been going on for months now between the Trump administration and the media and other groups. It never keeps anything lacking in interest. So what is going on in politics? Because the political implications are always influencing the markets nowadays in this realm of fiscal policy.
Well, a lot of people were talking about Trump's budget, which was announced on Tuesday, but that everyone says it's DOA, meaning dead on arrival, because it's mainly a political chess piece. It's here to say what Trump thinks and his administration are the most important areas to focus on. Now it's up to Congress to actually put something together. Like I said, dead on arrival, but elsewhere, not a whole lot of headlines, but underneath the surface, I think there's definitely a shift happening for the Republicans just in general. They're taking note of the calendar after Trump's budget proposal was released. The debt ceiling and the fiscal year 2018 budget will need to be passed roughly about the same time, near September. And there were some comments from Speaker Paul Ryan and the Treasury Secretary this week that they'll likely need to vote on the debt ceiling before that budget talk, so they'll try not to face so many political issues all at once.
We're talking with our members on this. It wouldn't be every Treasury Secretary says this, and every Treasury Secretary needs to say this. So I expect nothing less from a Treasury Secretary. They all should say that. They all do say that. And we're going to be talking with our members and with the administration on how we resolve the debt ceiling. The debt ceiling issue will get resolved.
The other important item, John, in Washington this week was it appears that Mitch McConnell and the Senate Republicans are quietly giving up the repeal and replace of the Affordable Care Act and are really instead shifting focus to passing the tax bill. And on that note there, Paul Ryan also this week said he's working on changes to his border adjustment tax. He was sitting down in a conference today, or rather I think it was on Thursday, in what seems like a move to close the gap between his plan and Trump's. And it definitely looks like if he makes the changes, a lot of the trade desks I've listened to are saying we're going to be looking at a border adjustment tax less tax bill pretty soon. So if he drops it all together from the conversation, chances are much higher that we'll get some movement on the fiscal side of things with a tax bill. We need to continue to check in on that each week to see what the progress is of that. Our feeling is the biggest effect on the economy and investing sentiment this year as far as Washington is concerned.
Okay, well, the FOMC minutes were also out this week from the early May meeting. Some economic numbers were announced this week as well. I mean, this is sort of usual standard procedure. First quarter GDP figure was revised big time from 0.7 to 1.2%. Any evidence that there's shifting the view that the economy had a transitory dip, according to the FOMC in first quarter, to something above 2% in the second quarter? I mean, because the press gave President Trump a hard time with his 3% projections, and we're having a hard time staying above 2%.
Right. The consensus feeling behind the minutes and the meeting ahead shows there's some concern over recent soft data in consumer price index. Way back in March, it was negative, and manufacturing, which has been soft, and other soft economic data. But as I mentioned over the last couple of weeks, there has been some decent recovery. Like recently, we looked at the Philadelphia Fed survey, which showed a huge rebound in April. The retail sales out this week showed another month of acceleration to around 0.4% growth in April. Sorry, the Philadelphia Fed survey, that was this month. Those are the soft data that we start to see for May, and that number was pretty positive. But yeah, retail sales also a jump in April. On the flip side, housing data disappointed in April by a decent margin. Also, we've been seeing auto sales have been an area of concern. And you look at AutoZone announced earnings this week and just got crushed. The consensus feeling is that the Fed will hike next month, despite all of this, despite, everything in the first quarter, because they said it's transitory. They're expecting that things are going to recover. But there's been a couple of Fed officials, like Williams this week, who said the Fed is under really no pressure to do more than 2 hikes this year. That's the first time I've started hearing some officials talk about 2 hikes instead of 3, which was projected back in December and reiterated again in March. So next week's CPE data, looking at inflationary information, should shed some light given the recent CPI data in March, and in April was, relatively soft.
Interesting times, Ryan. I mean, you mentioned the Treasury market, by the way, was a place to keep your eye on things. What's the update this week?
John, yields are not communicating the same message as stocks, and the weak U.S. dollar doesn't suggest yields are down because foreign dollars are flooding into the U.S. markets in all asset classes. Looking at other areas of the credit market like high yield, that doesn't show the stress it did back in 2015 when high yield started to fall, oil was falling, and there was a lot of concern around the oil industry. Still is to this day. In fact, I think the oil industry is the only SPDR SPDR ETF sector fund that's in the negative year to date. But, things look quite healthy here just in general. So there's a bit of a conundrum between this reflationary trade that started once Trump got in, and now a little bit concerns. I think the reflation trade has had to pare back a little bit given some of the difficulty in what Trump's been able to accomplish so far. But, going back to strong high yield has been great. The fabulous 5 are holding up equities and creating those new highs right now. There's a weak dollar and a bid under treasuries and a narrowing spread in the treasury curve. Those are some concerns. But if you X out that fabulous 5 where the market is focusing concentration, the S&P is still consolidating. Like I said, given the S&P equal weight. And you have a potential top in financials. You look at the financial ETF SPDR, and it's got a potential top formation. If it rolls over, that's completing and creating a top. So that's another area that, cyclically, there's strong areas of the market that just aren't communicating the same thing versus the other areas. Like I said, the high yield, treasuries, weak dollar, and then oil. Copper, too, has been correcting as well. If the top never completes in financials, it actually then becomes, this is the funny thing, it becomes a bullish situation. So I think there's a lot that is riding on how the economic numbers look over the next month, whether the Republicans can come together on a tax bill, and whether the Fed can thread the needle on its actions and communication next month. Because, like I said, year-to-date performance across the different sectors is another area of miscommunication. Technically, tech stocks are leading, followed by defensive utilities, followed by consumer discretionary, followed by 2 other defensive areas, healthcare and staples. These are non-cyclically oriented areas. Energy is the only sector that is down this year. The rest, and now actually financials, are flat. So mixed messages. That's, I think, the consensus of what I'm looking at on the charts.
We will have no lack of things to discuss, and it should be an exciting year here, but I really appreciate your input for all of our investors on what has been going on this week in the markets. Ryan Paplava, see you again next week.
Sounds good. Talk to you there, John.
You're listening to the Financial Sense News Hour at financialsense.com. To speak to Jim Paplava or his financial planning team, call us toll-free at 888-486-3939. That's 888-486-3939. We'd be glad to help you plan your customized investment portfolio.
In case you didn't know it, the Financial Sense News Hour is more than just our weekend show. We also have a weekday program featuring key economic experts, which is only available to our premium members. Here's part of one of the interviews from this last week.
I think commodities are a sector to keep an eye on because a lot of them are still very depressed. I think you could have some big bull markets in these sectors at some point. But if you're going to really follow the stage analysis system, you want to find markets that are breaking out of stage one bases into stage two. And you can't say that the commodities markets are doing that right now. A lot of them are back below the 30-week moving average. So you could see maybe these markets just grind sideways while you have bull markets in other sectors. These foreign markets, a lot of them are in these big multi-year consolidations where they really didn't experience the bull market with new highs like the S&P 500 and the U.S. markets did. Given the fact that they have been depressed, there's probably not a lot of bullishness in those areas yet still. And if they do break out, you'll probably see even bigger rotations of money into those markets as they start making new highs. If they do break out into new all-time highs and, continue their stage two trends that, they've been in for the last couple of years.
Well, it's been another good week for the markets with stock market indexes hitting new records. Joining us from Lowry's Research is Richard Dickson. And Richard, I know you guys track buying and selling power. Have you seen an increase in buying power, let's say in the last couple of weeks, that are driving these indexes higher?
Actually, the increase in buying power dates all the way back to November last year. Up until then, even from the February low, when we had started that renewed rally, buying power had been very weak. The market was rallying primarily on really flat supply. But that changed in November, where at the November low, just before the election, at that point, we went into a very distinct pattern of rising buying power or rising demand and falling supply. That's actually the most optimal condition for the market. Obviously, rising demand and falling supply is what you'd like to see. And that's where we are right now.
Richard, what do you think accounted for this kind of sideways action that we've seen in March until this recent breakout? Because with the exception of the NASDAQ, if you look at whether you're looking at the Dow, you're looking at the S&P or the Russell, they basically went sideways for almost a couple months until this recent breakout. So when you see something that goes sideways, is that just a healthy pause? People are trying to assess what's going to happen to the market, or is it a stalemate between buying and selling pressure?
In this case, it really seemed to be more of a stalemate. There wasn't really any ability to follow through on either side. You got a little bit of a sell-off. We had the very sharp drop back on the 21st of March, and there was no follow-through. And obviously, we had the big drop just a week or so ago, on the 16th, I guess, and that was a one-day affair. There was no follow-through on that. Then we started, that was the bottom, and before we started this rally that's going on through today, I guess. We'll see if the market ends higher. Right now it's slightly lower. But that has been the problem, is that there's been no real follow-through, either on the buying or the selling, since that March 1st high. I think what it has to do with really is digesting the sizable rally. You think in terms of the S&P from the November low through, I guess really through yesterday, the S&P is up 16%. That's on top of a 14% rally from the February low. So it's not unusual after big gains like that to see the market sort of move sideways, and particularly in this environment where there is so much uncertainty going on, obviously politically, but also as it affects the economy, because so many of these political decisions, whether you're talking about reform of healthcare, whether you're talking about deregulation, whether you're talking about taxation, all of them have the potential to have a fairly significant impact on the economy. And, of course, I think the market today is much more attuned to what's going to happen in the economy. In other words, for several years, you had a market that was really responding mostly to what they call the TINA effect. And there is no alternative. If you're looking for income, you have to turn to equities. I think that really changed to some extent after the Brexit low in June, more precisely after the November low, where I think the concentration now is on earnings. So we turn towards cyclical issues, although obviously the Dow Utilities has been making new highs on the recent drop in interest rates. But I think what has really rejuvenated the market has been this expectation that you're going to see an improved economy. You're going to see this 1.5%, 2% growth. You get back up to 3% growth. I think a big difference. So with the uncertainty that has really arisen in Washington about will the Republican agenda be able to be implemented, I think, people, they don't want to sell because there's a possibility that it will happen. But people, I think, are reluctant to buy because they've already discounted a lot of positive news. They're waiting to see, it's sort of a show me situation. So they're really reluctant to really buy. And if I can just continue my soliloquy for a minute here, one of the things that bothers us about this rally that we've had since that sell-off in the middle of May is the fact that it's been going up progressively less upside volume. It seems as though the buyers become more and more reluctant. Just to put specific numbers on that 141-point rally we had on May 19th, you had 84% upside volume. Since then, you've tacked on another 260 or so points, 270 points to the Dow, but that's been on 62%, 58%, 51%, and 43% upside volume on those 4 follow-up days. Today, obviously, is going to be something in that neighborhood as well. So that bothers us, in terms of, saying, well, we've broken out, okay, now, we're headed higher. To get a really legitimate breakout, you would need to see something much stronger than we're getting right now in terms of demand, short-term demand at least.
Richard, how much of this is reflected, and we certainly see this as a result of indexing, where you have, let's say, maybe less volume, but you have that buying concentrated in key stocks, like the FANG stocks. You take a look at Amazon, Apple, Netflix, some of these stocks that have really gotten to be pretty pricey. How much, when you see this lack of volume, is that the volume is concentrated in fewer and fewer stocks?
Well, if this were an unusual situation, in other words, if you were seeing this kind of thing, a consistent pattern, it'd be a little bit more of a concern, but it's been very, very spotty. There have been days when you've had rallies on very strong up volume, followed by, not much up volume. So there's just been a lack of consistency to the market. So you can't really, I think, point to a clear-cut pattern and say, well, it's simply because the money has been focused on 5 or 10 specific stocks and everything else is sort of languishing. We're just not seeing any consistency with that. So you had an 80% upside day on the 19th, you had a 70% upside day on the 10th. You can go back and forth on that. So I'm sure there has been an impact, and I'm sure that indexing has had an impact. You can buy, this harks back to the old index arbitrage in the 80s. You can buy a basket of stocks. You don't have to buy all S&P 500 stocks to really emulate what the market's doing, but obviously you do have to have the largest capitalization stocks in that basket. So, that probably has had somewhat of an impact on it. But then again, you'd say, well, wouldn't that have an impact on the overall volume? Yeah, and it really hasn't. It's been more on the up volume and down volume statistics, where we've seen that inconsistency. Overall volume's been averaging about 3.5, 3.6 billion shares for quite a while.
So given the fact that you're not seeing volume follow through on these upward increases that we're seeing in the index, is that in your mind indication of a possible correction ahead, or is this just a stall period where you've got a balance between buyers and sellers and everybody's just waiting to see what unfolds? Do we get tax reform? Do we get infrastructure spending? Do we get these great things that everybody's anticipating will come in the future politically?
Yeah, I think right now we are sort of in a stasis for the market. I know here we've been emphasizing, rather than look at the market overall, you need to look at the areas that are outperforming the market. Obviously, the information technology sector is going to be in the forefront of that. But you've had strength in things like consumer cyclicals. You have strength in industrials. Obviously, you've had strength in utilities lately. So I think there are certain things you can do in this market, even while the broad indexes are sort of in a stasis situation. The danger that you have, of course, is that since the market is elevated, as it has become over the last year and a half or so, there's probably greater room for disappointment than there is for fulfillment, if you want to call it that. That, what happens if this whole agenda falls apart? The expectations being as high as they have been, I think that would have a negative impact on the market. Hopefully, we would see signs of that in the market activity itself before that actually happened. And the good news is we're not seeing any of that right now. So, as things stand, just from a technical standpoint, the market's still in good shape. It might be sort of stalled out in the rally right now, but that really has not affected the overall underlying condition of the market in terms of the forces of supply and demand.
I want to talk about, you also track various sectors, and the thing that really strikes me, if you take the 9 sectors in the S&P, Richard, you've had 2 that really stand out, technology and then consumer discretionary. But a lot of these other sectors, whether you're looking at utilities, materials, industrials, financials, energy, a lot of them, in the case of energy, has been in a downtrend. A lot of others have been just basically going sideways for quite a bit of time. So once again, this almost speaks to what we've been talking about, this sort of concentration in fewer stocks, because you have basically only 2 sectors that seem to be leading now. Is that backed up by what you see, let's say, in your buying and selling pressure within industries?
Yeah, it's been, clearly very much an infotech market. There have been periods of strength in other areas. Industrials, for instance, have had some periods of strength. Consumer cyclicals, obviously, I think is the second best performer so far in the quarter. How much of that is Amazon? I think that's a legitimate question to ask. Certainly retailing and consumer cyclicals has not done well at all. So it's been very, very selective. What's interesting is if you look at the consumer cyclical spider, for instance, that's making new highs, we have an unweighted consumer cyclical sector that we follow here, and that's actually trading down near its lows. So there's been somewhat of a disconnect between that particular sector, and I think that's one reason you have to be careful. Understand that as long as Amazon's doing well, I think to a little lesser extent things like Federal Express is in there as well. I think Costco's in there. And as long as they're doing well, that spider should continue to do well. But you're not seeing really the underlying strength once you get beyond those few big cap stocks. So if they, for one reason, get hit, you could see that spider get hit pretty hard. So we're cautious, certainly, about the consumer cyclical, consumer discretionary area. So it's, to a degree, kind of a one-trick pony. If you're looking to see where the clear outperformance is, that's obviously in technology.
Yeah, it kind of reminds me sometimes when you see these markets, when they start to stall and you see it's kind of like what we call the generals. The troops are getting slaughtered, but the generals continue to climb up the hill. Richard, if there's anything that would concern you about this market, what would it be, and what are you watching to keep you alert to that fact?
Well, one of the first things you generally see in a market that is getting long in the tooth is a real underperformance, a consistent underperformance in small caps. And we're starting to see some early signs of that. When you look at we follow both our operating companies only, which is strictly common stocks, and then the S&P 500 and even the S&P 600. The advanced decline lines there are really starting to show some signs of weakness. It hasn't lasted long enough to really become an issue, but it is something, as you just asked about, it's something that we're watching. For instance, if you look at our operating companies only large cap advanced decline, that obviously just yesterday was at clearly new highs, very significant new highs. Mid cap, a little bit less so, but clearly at a new high, whereas the small cap advanced decline line made a new high back on April 26th. And it's below that right now. It's actually still trending lower. So, that sort of goes along with what we're seeing, obviously, in things like the Russell 2000 and the S&P Small Cap Index. But that divergence, if you will, between what's happening with large and mid caps versus the small caps is something that we are concerned about. We started to see that kind of divergence develop in March of 2015. And eventually it gets passed along to the advanced decline lines. We're not seeing it yet in the broad-based advanced decline lines, but this does continue, particularly if it spreads to the mid-caps. That's going to be a warning sign that we better start paying attention and looking for other signs of a potential approaching top. Right now, it's very preliminary.
Okay, so given what you're seeing right now, where we're seeing fewer and fewer companies that are leading the indexes higher, and you sort of have this standoff between buying and selling pressure, what would you be doing right now, Richard? Would you be raising cash, sitting on the sidelines to see what develops? What measures would you be taking as an investor?
No, I think that if you are certainly underinvested at this point, given the fact that we don't see any signs of real weakness in the overall market, and the suggestion then would be that this stalemate in the indexes will eventually be resolved to the upside. Now, I think you can be doing some buying with a focus on the areas of the market that are doing best. And, obviously that means infotech. It doesn't necessarily mean you have to be in one of the FANG stocks, but there are other technology stocks that are doing just fine right now, that are trailing along. But you can see that in advanced decline lines. If the advanced decline lines were going down, the index was making new highs like they were in 99 or early 2000, that would be a different story, but they're not. So I think you can be looking in areas. Industrials is starting to show signs of strength again, so that's something. Healthcare is something that we're watching very closely. Even finance looks like it might be basing out right now, so we're watching that to see if we see some strength there. So you can be focusing on specific areas of the market without really being too concerned about the fact that the broad market indexes are just sort of trading sideways. Obviously, if you've been in the infotech, even the XLK, you say, what trading rates? They're just making new highs. So given the underlying condition of the market right now, which is still healthy, there's really no reason why we can't do new buying right now.
Well, Richard, I know you track a lot of things in the market in addition to sectors. You also do international work. And by the way, you're one of the oldest stock monitoring newsletters and services out there. If our listeners would like to find out more about, let's say, your retail service, because I know you have institution as well, how could they do so, please?
Easiest thing to do is just type in Lowry On Demand into your browser. There's no E in there. We're not the spice company. So it's Lowry. Believe me, we get phone calls from people wanting to know about, what should they do with our recipe? We have too much spice in our so what should we be doing? Sorry, we got the wrong.
Yeah, barbecuing a steak. What kind of seasoning do I need to use?
Right, exactly. So the ladies are very used to it. But it's Lowry On Demand as one word. And you can be directed there to all the various levels of service that we offer.
You're listening to the Financial Sense News Hour at financialsense.com.
If you're approaching retirement age or concerned about making plans for those retired years and having adequate income, you're going to want to hear our Lifetime Income series every Monday and Tuesday here at financialsense.com. Right now, here's a preview of this week's Lifetime Income program.
Joining me on the program today is Robert Franick. He's co-author of a book called Colleges That Pay You Back, the 200 schools that give you the best bang for your tuition. Robert, before we get into schools and criteria, I wonder if you could just go through how you evaluate a college, the various things you look at in terms of rating, because as I went through your book, it is really quite comprehensive.
Well, I thank you very much, Jim, and it's good to be back on your show. I so appreciate it. And for that book, and I do several different books. I'm editor-in-chief for the Princeton Review, but I still write a couple of college admission research guidebooks, two of which focus solidly either on financial aid or return on your investment, and that's both the student's academic investment as well as they and their family's financial investment. But specifically for colleges that pay you back, a new issue just came out in the last week in January, so the data is still so fresh. There are 7 different ranking lists in that book, some of which, when we created the book, we said, but listen, we want to make sure that these have great utility for students and parents and counselors helping them along the way. So we focused on schools for the best internships, best career placement, best alumni networks. So things that I spend the majority of my time on the road throughout the academic year, visiting colleges and then spending time at high schools and talking to students and parents and, of course, with school counselors. And these are the things that those students and parents have been asking us about, and we did the homework at Princeton Review and put together those ranking lists.
Well, the markets are breaking out to new records. We have a new record in the Dow Industrials, and we also have one in the NASDAQ. We also have been seeing higher gold prices, and oil is on an upturn. Joining us on the program from U.S. Global is Frank Holmes. And Frank, you just got back with meetings with various hedge funds, some rather well-known ones, as a matter of fact. I wonder if you could just kind of bring us up to date. What was the message that you were getting from these hedge funds? What are they doing, and how do they view this market?
Sure. It's been great for me because I've been now a student taking notes rather than just talking. And you learn so much going both ways. But what's really, I think, important for your listeners is I was at SALT, which is the premier Skybridge Alternatives and Hedge Fund Conference. And they had just all the big players there speaking and conversations. And I was recently this week in New York, and I was at a Bitcoin event, which is still going on, and blockchain currency, trying to learn as much as possible in that space. And so what I found is that some of these great hedge fund managers like Paul Singer with Elliott Management, who has a 40-year track record, almost a 14% compound annual growth rate with only 3 down years, who became famous for suing the Argentine government and won, has an allocation towards gold. And he's a big believer in gold as an asset class. And to give you dimensions of his power, he raised $5 billion in a day. And so when that money gets deployed, it's people like him that see that there's too much debt out there. They're concerned about the debt levels and the policies of the governments to resolve them. He just thinks that it's intellectually corrupt. He's a Harvard lawyer, and it's interesting hearing that from a Harvard lawyer practicing in the capital markets.
So he believes everyone should have some gold, and you have always said that, no more than 10% and you rebalance. Frank, what's your impression of gold here? We've seen it sort of bottom in December of last year. We've seen a series of higher highs and higher lows. We're kind of in a stall speed here, but do we go out and take let's say the highs reached last year over 1,300? Because traditionally around this time of the year, you get into the slow months of the summer where gold traditionally falls back.
It's a good observation. When you look at these macro factors in economics, there's 3 things to consider. Secular. Are you in a secular bull market or bear market? That's very important, which means it can last from 3 to 5 years. Is it a cycle? Do you have an annual seasonal cycle for it? And when it comes to gold, there's 30 years, and we've published this many times, showing the 30-year studies on gold and oil and copper, and the patterns over 15 years and 5 years. When it comes to gold, there is a high propensity to find a bottom in late May, early June. And it usually cusps with the beginning of Ramadan, which is a 20-day fasting holiday in the Middle East. And there's a lot of gold gift giving, and that's usually the first movement that you see. And you have this series of rallies up to the Chinese New Year. We're going to Indian season in the fall, 2 sets of wedding seasons and their New Year, and then we'll have Christmas, and then we'll have Chinese New Year. And just like this year, we had a big rally up to Chinese New Year, and then it started to phase and roll over, and now we're going to another rally. I think part of this new rally is also adding to the fuel of the fire is negative interest rates. They were positive, next to negative, and you can see the inverse relationship on our website. I publish extensively on the significance of the real interest rates for 5 and 10-year government bonds. Whenever they're negative, go rallies.
So, Frank, if you were looking for one catalyst that would, let's say, propel gold prices higher, would it be this, negative interest rates?
Yeah, I think it's negative interest rates, and I think it's a much better bet. If you bet on North Korea going to bomb South Korea or something of that nature, gold rallies, the stocks don't, the stock market crashes. So I don't like betting on those type of scenarios, and they're truly black swans that can happen, but you can't live your life, I think, betting on such massive negativity. But you can be rational and intelligent in seeing governments are imbalanced between their monetary and fiscal policies. And when they're imbalanced, like we are now, we've been on steroids for something like 16 years. Under President Bush, it was steroids on regulations. Sarbanes-Oxley came out and public issues dropped by 75%. I wrote a piece not too long ago that McKinsey also wrote about, that there's a shrinking number of public companies. And it's a layering of these regulations one after the other that they're creating plaque in your heart. And so the solution to that by governments is to keep interest rates 0 or 1%, but if to do that, they're doing it at negative real interest rates. And anytime you have this negative real interest rates, gold is a great asset class. It just performs exceptionally well. And that's why we look at it.
Frank, isn't one of the real issues, too, now? There is so much debt out there for governments, including the U.S. We now have a $20 trillion deficit where, 8 years ago, it was $10 trillion. So, as interest rates begin to rise, it's going to cost governments more. So isn't there even a greater incentive? I read recently that the ECB's balance sheet now exceeds that of the Federal Reserve, and Japan's balance sheet is rising still. So we still have an ocean of liquidity that is going into the world global financial markets.
Well, that's a very great observation, and there's so much truth to it, and Paul Singer articulated this. But I think there's something else that's missing, and that is the money supply, what they call the velocity of money, has not kicked in. So why is that? It's regulations. They may print all this money and put it on their balance sheets, but if it doesn't get out into the system, then you have difficulties of getting strong economic growth. And that's the imbalance. It's a regulatory body in Washington and the EU which caused Brexit, where you have non-elected officials having tremendous powers. Tremendous powers. The EPA has their own, what do you call them, Rangers or Navy SEALs, their own military regime to go in to attack you if they don't like what you're doing on your property and they don't do a cease for them. The SEC has their own administrative courts proceedings that you don't go through a normal jury and have an open debate. And supposedly 98%, 99% of people that go through the SEC's tribunal court system, whatever, are guilty. And so as long as all those regulations, and we need good regulations and we need good referees, but they have to think about streamlining previous regulations, otherwise nothing gets done. And so with that, we're going to have all this money being printed, but it's not getting back in the system. And they keep trying to get inflation, but to get inflation, you have to have velocity of money rising. So that's the big missing point that's out here. And I think what President Trump brought in was a 2-for-1 rule, which Canada did, which helped improve that under Mulroney, where you can't create a new regulation without canceling 2.
So do you think that a lot of these regulations will be removed under Trump? Because, he's got several ideas: repeal health care, tax reform, infrastructure spending, and deregulation. And it seems about the only thing he's been able to do so far with the executive orders has been deregulation. Health care is stumbling, and they're saying it may not get done this year. They keep saying that we may get tax reform, but that there's a divisive, or at least a division even within the Republican Party. So that leaves regulation. In your opinion, you follow politics, what do you think gets done this year?
It's a very good question, because last month I wrote about this. I went to Washington with a group of analysts and had the opportunity of going to the Senate and the Federal Reserve and the Treasury Department. And what came back from that was 2 things. And the second part of that is what Bernanke spoke at the SALT conference. And he said, you have to look at, there's 3 parties in Washington. There's Democrats, Republicans, and there's the Beltway Party. And that Beltway Party is a consistency of very powerful regulators that have been there a long time, technical bureaucrats and lobbyists that seem to have their own way to stifle change unless there's more regulations. And so with that, he said that President Trump is much more similar to President Jimmy Carter. Both are outsiders. Both want to try to change the process for regulations or rulemaking, and both have tremendous leaks that are coming out of the government that are anti that outsider. So I thought that was interesting, because when I heard this sort of similar message when I was in Washington, and there's a rule that basically says that you're only allowed 3 strikes at the ball in 1 year to change major policies. And the three strikes, that is when we talk about Obamacare, that it touches both healthcare and taxation. So therefore, you're using 2 of your 3 strikes. So it's impossible to get lots of rules and regulations changed with that third party, that other political beltway party. And they're entrenched with this. So unless it's called delta neutral in spending, and if you change the taxes, it has to be exactly no change in the collection of the taxes and the distribution of taxes. So if you want to get corporate taxes down, then you have to go show where you're going to get the corporate tax differences from somewhere else. And so it's very, very difficult. All the ambitions that Trump had and which we voted for are going to be extremely difficult. So the easy thing for them to do is to go for the low-hanging fruit. Don't talk about personal income taxes, because that's a big political football. Just do corporate. Just focus on corporate taxes. Don't talk about Obamacare. Wait till 3 years out and just show it's continuing to be difficult, or 2 years out. Go for low-hanging fruit and go for things that you know you're going to win and get that momentum for that change. And the other big part of going to these conferences, everyone tries to label the people who voted for Trump or either rednecks or blue-collar union workers. And I find it was just really amazing, because the data points are small businesses, which create 60% of the jobs. Many Democrats that are called conservative Democrats voted for Trump because they can't grow their business with all these regulations, one form or another. And that was a big part of which I gleaned from these conferences, that the audience that voted for him up through the middle part of America predominantly are small businesses.
So as you see this, what does this mean for the markets? If regulation is peeled back, does velocity increase? And we know if velocity increases, credit flows through the system, and eventually that becomes inflationary.
That's correct. And you can then have rates rising and get to a real price discovery of interest rates. The ultimate of socialism is to have no price discovery. So when you have zero interest rates, how do you have price discovery? Governments try to regulate the price of bread at one time in England, and that helped usher in Prime Minister Thatcher. And so I think that we're imbalanced with this monetary to fiscal policy, and having rates rise so that they're 200 basis points, 300 basis points higher from now, that would be okay if you're getting real, true economic growth. There's no capital expending that you're having right now, and the concern is there's been a pullback in capex. And so companies are not spending money on fixing their buildings up to the degree they should, and buying the other technology as they're buying back their stock. Buying back their stock only makes lawyers rich. And it helps the shareholders because there's more value in a revenue and cash flow per share. That does help the stock market, there's no doubt. But overall job creation, the multiplying effect of money, you have to have capex spending. And I think that the market is saying that Trump is going to get some things done. That's why this market is a Wisdom of Crowds. It's a wonderful, wonderful book I highly recommend. Easy read, full of great case studies, when the crowd is wise, and what are the factors versus groupthink. And the fact the market is doing this is saying that he's going to get some push through. Now, what do I think he's done positive? President Trump? Well, 2 weeks ago, the Chinese leader announced a $100 billion big expansion around the world for the Silk Road. That perked up the commodities. Everyone got great. China's going to save the world. And out of 2 weeks later, President Trump's out going around the world, and he's going to bring back, first deal was $32 billion, then it's $52 billion, and it's growing to over $100 billion. So that type of competitive spirit of him pushing for big economic trades, and along with China doing what they're doing, is good for the market. And I think the market is signaling that.
So as you look at the markets, whether we're looking at commodities, either gold or oil, or looking at the stock market, given where we are today, what would you be doing?
Well, I would really stay this focused on those stocks paying dividends and growing dividends at any category. I would keep my cash in short-term tax-free, which I've done. And I would make sure I got that exposure to gold, because I think that gold runs back to $1,500. And if you get any type of silliness out of North Korea, then it could go to 2,000. But I think it trades higher. And from that end, the big leverage is going to come with gold stocks. And the gold stocks themselves have been really hurt because of this whole GDX and GDXJ. More money's gone into that ETF than any gold mutual funds, and it's distorted the collection of capital. It's all gone into the GDX for gold funds. And what's happened is they only buy X names, and it's only based on market cap. And all of a sudden, they're going to own 20 names names more than 20% of these names, which they can't do. So now they've been blowing them out. So $5 billion went into them, and they're selling $3 billion of juniors. And that's been very disruptive to junior mining companies who are doing a great job, because it has nothing to do with the price of gold. Their stock has gone down. It has nothing to do with them making higher earnings and cash flow. It has all to do with fund flows into the GDXJ. So I think that it provides your listeners looking for certain gold stocks a great opportunity to buy some of these stocks, like which we love, is with big holdings, Klondex. Nothing but good results. Companies doing an exceptional job. They're dominating Nevada, and it's things like that companies like that get whipsawed.
All right. Well, listen, Frank, as we close, if our listeners would like to follow your work, tell them the easiest way to do so.
Go to usfunds.com and sign up for the Investor Alert and Frank Talk. They're free. They're published every week. They're always a balanced SWOT analysis, strengths and weaknesses, and opportunities and threats. They're always a total collection of 12 sentences so that there's no run-on. Comprehensive and concise, written by portfolio managers, and it gives you a good flavor for how money managers, active managers are thinking.
Now, coming up next on the Financial Sense News Hour, megatrends. 5,000 stores, retail stores, are estimated to close this year alone, and with them will go shopping malls. It is projected. Is this the end of it, the end of retail sales, or is there a new merger coming between technology online and the physical stores? And also, how is it that the experts on Wall Street and in the markets and the Fed always get things wrong in their forecasts, especially if they're experts? Where do these chasms develop, and how do we figure our way through them? All of that coming up next as Jim and I go into those subjects on The Big Picture as the Financial Sense News Hour continues at financialsense.com.